Good morning, everyone. You are watching a live daily market outlook for Tuesday, 18th of December 2012, prepared by Windsor Brokers. The main characteristic of the past 24 hours trading is could be described as consolidative, corrective, following stronger movements on yesterday's market opening, with of course dollar yen being a top performer yesterday and hitting fresh 1.5-year highs at 84.32. Consolidating currently the latest strong rallies, similar with the single currency that basically failed to touch psychological 132.00 barrier, and currently moving sideways within the consolidative around 30-40 pips range, but downside remains slightly more favored at this point due to some technicals that we are going to go into details later on. Sterling is still steady around 162 following yesterday's brief break above this psychological barrier, and hitting a high at 162.18. Again, signals of some more significant corrective action are seen. Dollar Swiss is moving within the narrow range. Some movements are now seen at the beginning of European session, consolidating heavy losses that dipped yesterday to the lowest at 51, but still the upside initial barrier at 92.00 stays intact. Gold is recovering slightly, currently testing our initial and psychological barrier at 1700, being a bit slightly supported, and basically investors are waiting the more positive signals for the US fiscal cliff negotiations that started again yesterday. More of this, of course, we are going to see now in a couple of minutes, with the crude oil holding positive in past few sessions of recent low at 85.20 posted last week, with 87.84 seen so far, approaching our barriers at 88.50, that clearance of which is basically required to improve the near-term structure and look for a possible break of the possible move towards the upper boundaries of the near-term range where the oil price currently moves. As said, the differences on how to resolve the fiscal cliff narrowed significantly yesterday. We mentioned in our yesterday session that some positive signals came from states as President Barack Obama made a counter offer to Republicans that included the major change in position on tax hikes for the wealthy, according to the sources that were familiar with the talks and that leaked this information. The move, which the source stressed was not Obama's final offer, was welcomed, albeit with reservations, by a spokesman for Republicans' House of Representatives Speaker John Boehner, who met earlier in the day with Obama as the two hammered out a way to avert steep tax hikes and indiscriminate spending reductions set for the beginning of 2013. Considerable work remains as both sides now try to bridge the gaps between them and then sell a package to their respective allies in the U.S. Congress. In the most dramatic change in position yet, the White House proposed leaving lower tax rates in place for everyone except those earning $400,000 and above, and that's up from 250,000 threshold that the president has been demanding for months, but still far from Boehner's preference of 1 million. President Obama also moved closer to Boehner on the proportion of the 10-year deficit reduction package that should come from increased revenue as opposed to cuts in government spending. Obama is now willing to accept a revenue figure for 1.2 trillion US dollars, down from his previous proposal of 1.4 trillion US dollars. From the other side, Boehner's latest proposal calls from $1 trillion in new tax revenue, which would come from raising rates and limiting deductions that the wealthiest can take. Some of the savings in spending proposed by President Obama would come from reducing the size of cost of living increases for all, but the most vulnerable recipients of the Social Security retirement program, though the use of different formula to calculate the regular raises called the Consumer Price Index. Pardon. President Obama and Banner remained apart on the politically explosive issue of how and when to raise the government debt ceiling to permit the government to borrow more money. These are basically the highlights, as markets were rather quiet in the past 24 hours, as we said, consolidating the recent strong movements. With today's calendar seeing some releases, important releases from UK. The inflation report is due at 9:30 GMT, with the yearly release for November seen at slightly below the previous 2.7 in October. 2.6 is today's forecast, while the core CPI for November remains unchanged according to a forecast at 2.6%. PPI input for November on a monthly basis is forecasted at 0.3% compared to 0.4% in October, while PPI output is 0.2% versus 0.1%. Retail price index is seen slightly lower in November. 3.1% is today's consensus compared to 3.2% in the month of October. And the home price index, we don't have forecast. 1.7 was the release of a month of October. And from America's United States third quarter current account shows the narrowing of the gap to 105 billion US dollars compared to the gap of the second quarter of 117 billion US dollars, and this is at 1330, and at 1500 this housing market index for December. That is according to the forecast of 48, expected to tick higher from November's release at 46, and basically that's all that we have significant on today's release. On today's releases, we're going to take a look now at the markets and see the latest movements in major currencies, commodities, and see the technical outlook for the coming sessions. As said, Euro is consolidating the recent rallies that peaked yesterday at 131.86, being just slightly short of 132 psychological barrier, where the upper 30 days Bollinger Band capped the rally, and currently the pair is in the consolidative mode, but near-term structure is slightly aligned towards the downside. As we can see, the hourly indicators are all pointing lower, with initial support being at the range floor at 131.43. This was low of yesterday, and the more significant levels seen on Fibonacci supports and previous highs. We have the 131.25. That's the previous peak of 5th of December, seen as the next, along with the 131.00. That's the psychological support, and the previous highs of 13th of December. Basically, the dips should be contained at around this zone in order to keep the immediate bullish structure in play, and look for a possible fresh extension higher. As overall structure is still positive and bullish, and sees more room for further extension higher. Of course, we need to see the clear break above 132, despite barrier at 131.70 being dented. Sustained break above 132 is set to open next upside there. Barriers 132.82 is the peak of 1st of May, and then 133.00 is round figure and psychological barrier seen on the clear break. Currently, we can describe the current movements as corrective, consolidative corrective, with good supports at 131.40 zone, and then 131.00. On the downside, loss of 131.50 levels, approximately 131.50.40. This is the zone. This is between 38 and 50% retracement of the upleg from 128.76 to 131.86. Could further delay bulls and allow for some stronger corrective action. Otherwise, ideally, basically ideal reversal should be seen somewhere between 131 and 131.70 in case of deeper reversal, to keep the bullish structure intact and see the renewed attempt towards psychological and strong barrier at 132.00. The beginning of European session, sterling holds stable, holding around the 162 level, following a break higher yesterday and overnight. Yesterday's highs at 162.15 and overnight one at 162.18. Still keeping the upside in focus despite descending hourly indicators, as the initial support and the current range, consolidative range floor at 161.92 stays intact. Basically, the price is at the beginning of European session holding around 162, around hovering around the 20 days exponential moving average, ahead of previous highs and the previous double top at 161.74.78. That is seen as the next good support. Further down, further retracement basically of the current rally could see the focus shifting towards the downside in case we lose 161.70 and 161.50. That marks approximately 50% of the latest uplift from 160.84 to 162.18. Basically, break below this level could signal delay in the current bulls and the open way for some more significant corrective action that would also shift focus towards the strong supports on the downside at 161 at and 160.80. Conversely, reversal around or above 161.50 is seen as ideal point for fresh extension higher, where we'll be looking for test of 162.71. This is the high of 28th of September, and then the most significant and key barrier is 163 zone psychological resistance and 163.08 peak of 21st of November. That's still our initial upside target. And the dollar yen is currently pausing in the strong rally, and yesterday's gap higher opening that peaked at 84.32 levels seen last time 1.5 years ago, but immediate easing lower so far were contained at 83.60, failing to fill the gap, which is at approximately 83.50, and the subsequent push higher failed to regain the previous levels, stalling at 84.07. Basically, 84 now acting as initial resistance. Probability of further easing is quite high now, as we can see hourly bulls are running out of steam, though still in play. With the hourly studies, hourly indicators now starting to point lower, the stochastic already reversed towards the downside. That will shift focus down to 83.60 and 83.50. Basically, a break of these levels is to be a trigger 83.50, and a more significant 83.30, which is the low of last Friday, would give us more signal of possible further corrective action of the current recent strong rally, with the reversal points, with the Fibonacci points, seen at 83.47, which is close to our gap high at 38.2% retracement of 82.09 to 84.32, and then 50% retracement at 83.20. Basically, if we see the break below 83, initial 83.60.50 and then 83.30.20, then we'll be talking about some more significant correction of the current of the recent strong rally that peaked at 84.32, and possibly to look for a test of 83.00. That is previous resistance zone, now acting as good support. Previous peaks at 82.80 and 83.00 psychological level will be giving a good support, and this support is reinforced by ascending 55 days moving average, currently at 83.10 on the 4-hour chart. Conversely, holding above yesterday's low at 83.60 and the regain of minimum 84.07, which is the overnight high, would again refocus the upper barriers. Then we have yesterday's intraday high at 84.15 and the peak at 84.32. That will open way towards 84.50 and then 85.00, which marks 200 days moving average on the weekly chart. And basically 85 is still acting as our initial upside target following yesterday's break above the previous yearly high at 84.17 and posting a fresh one. That will be looking for a test of 85.00 and then 85.51, which is the peak of April 2011. The dollar Swiss is holding within around 50 pips, 40-50 pips corrective consolidative range, still in the sideways mode following yesterday's dip down to 891.51 with the 92 initial barrier psychological resistance still staying intact, though some movements seen at the beginning of European session, possible attack higher where we have the descending 55 days moving average close to 92.00 as initial static and dynamic barrier, break of which is basically seen as initial signal for some possible stronger corrective action ahead of another important levels at 92.13, which is the previous low, and then 92.40 zone, the previous lows and previous base. Basically break above 92.40 is required to signal some stronger corrective action and avert immediate downside risk. The 92.40 basically is approximately 23.6 Fibonacci retracement of the down leg from 95.11 to 91.51, while the break above psychological and 93.00, which is slightly above 38.2% retracement, would give more credibility to the possible stronger move higher. However, the larger picture bears are still firmly in play and intact and still keep the downside favored, as a loss of 91.51 would open way for a fresh extension lower, as the base, strong base at 92.13, 92.00 has now been lost. Basically, this is the floor of the past 3 months consolidative range 92.00, 95.00, following a stronger down move from 99.70 yearly peak of 24th of July, as these levels have already been cracked and broken. The further extension lower and the resumption of the broader downtrend is seen as a likely scenario in the near term, with the 91, as we said, seen as the next downside target from Ichimoku studies, just to confirm that bears remain firmly in play on the daily chart. The chart is well below the cloud, and the moving averages Kijun and Tenkan Sen keeping the downside in focus. However, near-term structure is still seeing a potential for some corrective action. As we can see, the momentum is currently breaking above the midline, and the MACD approaching, while RSI is pointing higher, might leave some room for some corrective action. But as said, overall negative tone doesn't leave much space for any stronger corrective movements unless we see break above break point at 92.40. That may allow for some stronger corrective movements. And gold is averting immediate downside risk, has bounced from a low of yesterday at 1686, now tests again 1700, 1703 seen so far. Basically, the initial resistance at 1702 has been cracked now, with the 4-hour structure improving, now gaining some momentum, but still lacking strength to clear initial dynamic barrier to 55 days exponential moving average. From the other side, the bullish crossover 10 over 20 exponential moving average sees the downside underpinned, the current move, underpinned, and looking for possible further retracement of the down leg from 1723, that is the high of 12th of December, down to 1686, low of yesterday. Keeping basically the current bounce keeps the immediate support at 1684 double bottom currently out of reach, and averting immediate downside risk, but still a break above 1710 that marks approximately 61.8% retracement is required to confirm the recovery and look for possible stretch higher towards 1723, our initial and the key barrier in the near term. Important to say that current negotiations about fiscal cliff in case of a positive solution for the current problem are seen by most of analysts as supportive for gold that would be acting again as a safe haven instrument, while missing to reach an agreement would of course trigger, apart from a disastrous scenario of pulling United States back into recession, would again will be seen as a strong pressure on the yellow metal that is already quite under strong pressure following a reversal of yearly peak at 1795 that so far dipped to 1672. Basically, any failure of current corrective action with the daily structure still being in the negative territory would again shift risk down towards 1684 and 1672, below which is the 200 days moving average at 1661. This would be signal, basically break below 1672 would be signal of a fresh extension of the down move from 1795, ending basically the corrective consolidative, I would say corrective consolidative action of 1672 that peaked at 1752 where the gains were limited. And finally the crude oil that is in the recovery mode in the near term. We have moved to the February contract as the January one expires tomorrow, 19th. Hourly structure is still lacking strength. Bulls are still running out of steam. However, the 4-hour ADX shows bulls in play off recent low at 85.20 following yesterday's, last week's gap higher opening, and basically the price broke above initial barrier at 88.18. This is the high of 12th of December 2012. So far retracing 61.8% retracement at a level of down leg from 90.31 to 85.20, with the upside being now in the near term focus, as 4-hour studies are still firmly pointing higher. However, break above this level 86, 88.36 and the previous peaks that are approximately at 88, 50, 60 zone required to confirm the recovery, and the open way towards 89 and 89.10 that marks 76.4% retracement. Yesterday's low at 86.99 now acts as initial support, where was also the bullish crossover of 20 over 55 days exponential moving average, currently underpinning the advance and static support at 87.00, ahead of channel support that is back in play as trendline support currently at 86.56 that guards the downside, the levels at 86.00 and then 85.35 and 85.20. That was all from me for today. It's a time now for you to submit your questions. If there is any question, please. I have a question for Euro Yen. It's quite similar to Euro Dollars chart. Of course, each instrument is unique. Basically, the pair is currently consolidating the recent strong rallies with the yesterday's gap higher opening hitting level at 111.17, just ahead of 111.42. That is the peak of 18th of March, 2012. And this is also the yearly high, basically just lacking few ticks for full retracement of 111.42 to 94.10 down move. Hourly structure is still pointing towards the downside, as we mentioned, I think yesterday. Strong bearish divergence seen on the hourly studies is seeing potential for some stronger corrective action as the indicators are pointing lower. 4-hour chart conditions are extremely overbought with the RSI now emerging out of the overbought territory. The MACD is reversing lower as well as momentum that gives some hints of possible stronger corrective action, and looking for a test of the initial support at 109.91, 110 as a psychological and 109.91 as initial support. I think we can better see it here. This is just take a look to be sure. Okay, we're talking about the same thing. This is initial support range, current consolidative range floor, as well as 23.6% Fibonacci retracement of up leg from 105.96 to 111.17, reinforced by 55 days exponential moving average that is currently starting to move sideways, while the 10 days moving exponential moving average is starting to point lower, as bearish crossover below the 20 days one would confirm the negative tone. However, the loss of 109.91 as range yesterday's low and the consolidative range floor that will confirm the filling the gap would open way for some stronger corrective action, where we have this is also the break point, as we have the previous low of yesterday and the previous low of last Friday, seen as a trigger for a stronger reversal. 109.18 is 38.2% retracement, and the static support 109 was also psychological support low of last Friday, seen as the next downside target. Holding above, I would say 110, 109.90 would still keep immediate bulls in play. Basically, we would likely see the further consolidation and sideways movements, while lift above overnight's high at 110.73 would shift focus again towards 111.17 and possible full retracement on extension to 111.42 yearly peak of euro yen. Any further question, please? Silver, okay, we haven't spoke about silver for quite a long time. Let me put the chart for a second. Okay, the silver's hourly structure is turning positive now, following bounce of yesterday's fresh low at 32.00. Basically, this is our strong support, also marking a Fibonacci expansion of 50% Fibonacci expansion of the third wave from 34.39 as a part of the larger down move from 35.36 peak of 1st of October. With the 4-hour, with the 4-hour indicators still in the negative territory, and I would say at this point lacking momentum for any stronger corrective action. We have the 20 days exponential moving average currently limiting the upside, along with the previous lows at 32.50. This is our initial support, while further retracement requires a gain of 32.70 approximately, which is the high of last Friday. Also approximately 38.2% retracement of the down leg from 33.78 down to 32.00. Basically break above 32.70 is to signal basing attempt and avert immediate downside risk of revisiting 32.00. But as we said, overall tone is still quite negative, as daily indicators are now below their midlines and seeing more potential towards the downside. The price is now below the 90 days moving average, currently at 32.66, with the 55 days one reversing towards the downside, and looking for a bearish crossover that will basically signal the dead cross and further pressure on the silver price. As we said, the regain of 32.70 would provide some relief, while a break above 33.00, this is approximately 61.8% retracement, is required to shift focus higher and prevent the price of silver price from further sliding and testing of 3200 and possible extension lower towards 3153 that marks 76.4% retracement of the recovery rally from 3065 to 3439. Any further question, please? Okay, if we have no other questions, then I would like to conclude today's session. I would like to thank you for being with us and expect, of course, to see you again tomorrow morning in our regular session. I saw some attendees coming, connecting later, so in case you missed any part of the presentation, you can find it shortly. Will be uploaded into YouTube. Our page is called Windsor Brokers Forex, where you'll find a big variety of technical analysis updates and reports. We are back tomorrow morning at the same time at 8 o'clock GMT. Until then, I wish you a nice Tuesday and, of course, a very good and successful trading. Good luck.